If you are trying to invest in artificial intelligence right now, you are likely overwhelmed by the constant noise. Every company claims to lead the sector, making it difficult to tell who will actually survive long-term. Many retail strategies fall apart because they focus on the excitement of the technology while ignoring the underlying business mechanics. We have to answer a very specific question. Which of these companies are generating real profit today, and which are burning cash just to stay relevant? To find that answer, we are looking past the marketing claims. We are going straight to the SEC 10K filings to trace exactly where the money is moving. Surviving this boom requires a transition from picking good technology to evaluating favorable, risk-adjusted returns. The AI economy operates as a segmented, three-tiered infrastructure stack. At the foundation are the silicon monopolies, the hardware manufacturers building the chips. In the middle sit the hyperscalers. These companies build the massive data centers and the software models that make AI usable. At the top are the enterprise integrators. They package these tools and secure them for legacy corporate clients. This diagram shows how capital currently moves. Revenue from the top two tiers funnels straight down into the hardware layer at the bottom. You have to decide which layer of this pyramid aligns with your own investment timeline. Picking the wrong layer for your time horizon guarantees underperformance, even if the sector as a whole succeeds. We begin with the dominant hardware rulers, NVIDIA and AMD. These companies manufacture the accelerated computing chips required to train any major AI model. Because they control the physical supply, they are seeing an immediate surge in cash flow. This table from NVIDIA's 2026 filing shows the sheer scale of that generation. Revenue reached $215.9 billion, supported by a 71.1% gross margin. However, hardware sales are highly cyclical. Maintaining these margins relies entirely on a few massive companies continuing their current buying sprees. There is also a hidden vulnerability in the supply chain. NVIDIA is spending billions just to guarantee land and power for their partners' data centers. The silicon tier offers the highest current profit in the stack, but it carries extreme downside risk if cloud spending ever pauses. That brings us to the middle tier, the hyperscalers who purchase all that hardware. Companies like Microsoft, Google, and Amazon build the physical cloud platforms and proprietary tools that make AI functional for businesses. Maintaining this position requires a massive financial input, specifically in capital expenditure, or CapEx. This chart shows staggering infrastructure costs. In 2025, Alphabet spent $91.4 billion on CapEx, while Microsoft committed over $32 billion to physical data center construction. These assets age quickly. If consumer demand falters, these investments become massive balance sheet liabilities through depreciation. Investors in this tier are accepting lower short-term free cash flow in the hope of building an unassailable software moat for the future. Investing here is a decade-long game of CapEx survival, where short-term financial pain is passed directly to the shareholders. Now look at the top tier, enterprise integrators. These are legacy giants like IBM and Oracle that bridge the gap for non-tech corporations. These companies facilitate hybrid cloud transitions and scale mission-critical data security for legacy corporate systems. This business model generates safe, highly sticky corporate contracts. It avoids the need for massive new data center builds that define the middle tier. This table from Oracle shows the quiet growth in the sector, with cloud infrastructure revenues jumping 77%. You accept significantly lower top-line growth compared to NVIDIA in exchange for downside protection. Integrators offer a safe, dividend-yielding haven, capitalizing on corporate software integration rather than raw compute power. Moving from balance sheets to strategy requires evaluating your own investment time horizon. We evaluate capital placement by mapping risk against expected withdrawal years. The silicon tier offers direct 1 to 3 year cash flow exposure, requiring careful exit planning. Integrators provide a 1 to 5 year path for downside protection. Over 5 to 10 years, hyperscalers become the focus, pivoting towards software subscriptions. Your holding period dictates your optimal AI asset class. The math of that timeline matters more than the hype of the technology. The AI boom is currently a massive wealth transfer from the middle of the stack to the hardware providers at the bottom. Timing this market successfully relies entirely on tracking the massive multi-billion-dollar CapEx digestion cycle of the major tech giants. Do not buy the hype of the technology, by the math of the business model.